Let's move on to the stock market analysis. Every week I show this important screen on the analysis that we offer. I think this is really important to read because it does give you a good sense of the way we approach our analysis and about you using what we provide. That I think it's very important that you understand the trade ownership, that the trades that you put on are not ours, they're yours. And if you take trade ownership really as one of the most important aspects of your approach to the markets, I think that your performance will be much, much better because you're not waiting for anybody to tell you what to do. You're not waiting for any information. You're just applying what we or what anybody shows you from any of the professionals around the internet, and then using that information to see how that fits with who you are as a trader and your analytical style. So really important. And there's a video in our library on trade ownership that I think is very important. So you could watch that. All right, so this is the stock market brief. Just going to talk a little bit about the stock market before I get into charts. Well, basically, tax selling ended. As you can see, the market rebounding today. There was a lot of tax selling at the end of December. I talked about that early in December, that I thought December wouldn't be a great month because it made sense that there would be this, high concentration of stocks that had big profits, that they would be under pressure as people took profits and then took losses against them on a lot of the other stocks that did not perform well this year. Remember that the vast majority of the gains were in 10 stocks, and the other 490 stocks in the S&Ps didn't do that well. So now we're past that tax selling period right now. Usually you get a little bit more in the beginning of the year, possibly as people decided they didn't want to take their profits last year. They would rather roll it into this year and then pay the tax on it this year. So we've had a lot of gyrations that we've seen in the market. There's no sign of rotation yet when I look at this. Now, we've talked a lot about the potential for the stock market moving up if it could get into a rotational period where you get the growth stocks and you get the small caps and mid caps leading the market up. There's not a lot there's not a high probability, in my opinion, that the market's going to get led up by the same stocks that it did last year. And if you watch our end of the year show, my upside projection is much lower than most of the analysts out there. And the reason is because I think that the market is not going to be able to get led higher by the ones that led it up for the last 2 years. Now, there's also worldwide economic woes that are really very apparent. This is especially in China. Now, something that most people don't look at, but I think is very important, and I'm going to show you a chart on that, is the bond market in China. Of course, China's been, for decades a growth leader. And in the last recent years, because they had so overexpanded, they were really having trouble stimulating their economy. Now, China 10-year bonds are at the lowest levels ever, and the yuan is under a lot of pressure. This is all very important, and I'll talk a little bit about more when I show you a chart in here. So the slowdown that the China is getting, and Europe certainly is in a slowdown. Germany, no growth at all going on over there, maybe slightly negative. That's not good for the U.S. economy. And the stimulative effect of Trump policies that people have celebrated, I think that's over. And I think that if anything, there's more disappointments coming in the stock market once President Trump gets in office. And volatility remains as we see a very wide intraday chop in the market going on. We've seen this now for a number of days, and we have the VIX elevated. Now, in the year-end show, I show the VIX is in the very early stages of the monthly pattern, which is pointing to potential for elevated VIX and potential for upside spikes. which is greater than the potential for declines in the VIX. So inversely, that means the potential is greater for big declines in the market than there is for big advances. I think it's going to be hard fought to get upside moves. And if you saw our analysis that we did just a few minutes ago in some of the stocks, you can see that some of the leaders are looking like they are breaking down and having some trouble. So a few charts that I want to show you in here that I think are very important graphs, and then I'll get into looking at the indexes. First one I want to look at is the Chinese 10-year government bonds. So here you can see what's happened just here in the last year, as they've gone from roughly 250 all the way down to 160. This is because of extreme weakness in China, and they are essentially exporting deflation to the U.S. as the yuan drops. So the U.S. dollar is the strongest we've seen it in ages. The yuan is extremely weak. We have the prices. That means that the U.S. pays for Chinese goods is much cheaper. Very, very strong dollar, a weak yuan, and that is not good for our companies here. It is stimulative to the companies in China, but what does that mean? It means that the tariffs that have been threatened by President Trump are an absolute certainty. And he's not going to wait very long to impose those, because he doesn't want to see the U.S. have to the U.S. companies be under pressure because Chinese goods are so cheap to us. And he thinks that they cheat anyway in a lot of ways, and that might be a good argument. But when you look at this with interest rates down at historic lows in the 10 years, it shows you how weak China is. And you can't have, the second or third largest a country in the whole world under this, what really looks like a coming recession at best, without that bleeding into the rest of the world, and especially here into the U.S. I think once U.S. investors get it, U.S. rates will drop, and that will be at a time when stocks drop, sending the dollar down again. So dollar very strong, but if the stocks fall, as I believe that they will a couple times this year, and that the market doesn't get as much to the upside as a lot of analysts believe it will, that these declining phases in the stock market will send rates down and the dollar will fall again. So we're maybe very near where the peak of the dollar will be and the peak of interest rates will be. And right now, the market is pricing in less than 2 rate cuts here in the U.S. For this whole year. I think they're going to end up cutting maybe a little bit more than that, because I think there's going to be more weakness than the market is pricing in right now. So I thought this was a very, very important chart to show you. This is very important to our markets and world economies. The next one I want to show you is that while we have this situation of the China being extremely weak and the rest of the world having a lot of weakness in it, the U.S. S&P 500 price to book ratio is at the same level it was at, basically, or a little bit higher than it was back in 2000, before the markets, of course, went into 2 bear markets following that. I believe that we were going to get into a secular bear market. We're going to have a significant reset. I do believe that is the case. It doesn't have to be today. And sometime this year, we can make new highs, as I expect. But still, it's looking at this, it's really going to keep the stock market from being able to make very significant moves to the upside. Another version of other things I've showed you of a market that's very overvalued. And just one more. This is that market concentration. This is the top weight of the 10 stocks. And you can see right now it's at 38 point something percent, 38 percent of the SPX is just in those 10 stocks. If you look, you got to have to go way over here to the Great Depression to see where they were buying up some specific big companies back over there. And that was in the case then, it was the steel companies and pushing up the indexes. Of course, there was no S&P 500, so that's a reflection of the Dow back then. But this is 38% of the S&P 500. You can see these other times, the Nifty 50. This is where I started trading back over here, where the Nifty 50 was pushing up the Polaroids and Xeroxes, and you know what happened to a lot of them. And then, of course, the dot-com bubble and the COVID pandemic there, where it had just before that gotten up to about 32%, but now we're at 38%. So source here for Zero Hedge, just a great look at a massive extreme. So, you know, what does this really mean? This means that it's going to be very hard for indexes to move up. This concentration is very significant. And at the same time, we're had a big rally led by AI, and we're at a time frame where we're starting to see commoditization of AI products, AI chips. And when that happens and then prices stop going up or begin to fall in the chip category, then there's a lot of pressure in the NVIDIAs and the Broadcoms, and those stocks that are doing really well and have done really well won't be able to lead the market up. So that's why it's important to get a rotation to be able to lead the market up and get the broader market expanding and money moving into that. But even then, it's going to be hard to get the indexes to move up. So let's take a look at where we are right now in the indexes as I switch over to the analysis of the charts. So we're looking at the weekly, the daily momentum conditions, which you can see have turned red there, and the 2-hour right over here. Let's take a look here as we see the momentum conditions and the cyclical patterns. So this green dash right there that you're looking at, that is the Russell. It's lined up differently than the stock market, than the S&P 500 and the NASDAQ. So the Russell trough is right over here. As you can see, the S&P trough looks like it's right over here. And you can follow the minor cycles right there. So there's a minor cycle, there's a minor cycle right there. And you have a minor cycle coming down here into February, March. We looked at some of the stocks earlier today, and that was suggestive of the fact that there was some weakness in a lot of these higher cap stocks that's likely to come into that period. We see Apple, you know, breaking down and coming down into that period also. Also look over here. So this is where the momentum turned up over here last May. It got into that minor correction. The momentum turned up right again over here. Through this corrective period, momentum stayed very strong. This was that very strong market that wouldn't correct. But now look at the reversal scout. It has turned over and it is negative. That comes at the same time in here that we're starting to get breakdowns on the daily chart. So DJV asked me the question about this cycle right over here. I tend to leave up cycles when I'm still looking at shifts. So I have this ghosted out, but it may still have an important influence on the market. You can see you got only a minor decline right over here. You got the bigger decline right over here, and this is where it began to shift. And then as you got into the end of the year, this really shows the failure as it got up in that rally and then turned over, and the momentum, as you could see right over here, has turned red on the slim ribbon PO. The slim ribbon turned negative right over here, so that's negative. That shows you that. This is your resistance areas. It just gotten into there right now, 59.20 up to about 59.70. I would expect bounces to be able to stop in that area. If the market could get up over this level right over here at 60.50, then I would start to believe something was better. But right now, this is a very negative look to it. You can see the cloud in here as it turned down, and now the lower track gets put in there because of this breakdown. So many times during the last year, the upper tracks were added because the market kept moving up significantly, but now the lower track is added. And the downside projection right now is 57.80 down to about 56.90. That's this lower track right over there. So that's what we're looking for. We would expect rallies like we're getting today to fail, rallies like we got yesterday and here on Thursday, which gave you that quick failure. So they could hold up today, they could hold up into early next week, but then we would expect that they would be turning down right there. You could see here on the momentum right there. If you look here on the bottom, this is the option bias indicator. Now, this gave you positive readings all through this period here. Turned neutral during this little correction right there, turned positive. You can see the slim ribbon PO giving you those positive readings. And then over here it neutralized and this turned yellow. It's a little hard to see that right there, but those are yellow right there, neutral, and right over here, negative. So this is telling you that with the slim ribbon turning negative, with the option bias indicator turning negative, that it's time to have your position, your option positions with a short side bias. We have not had that for a long period of time. We had a little period back over here last summer where you got some pullback in here and it got negative right there, but then you can see turn positive again. While this is negative, it's an important thing to look at and says to you, your overall option position should be biased to the short side. That's why I developed this indicator for you to be able to have that, because so many people get run over in their option positions by momentum because they think it's safe to be short premium. And the market taught you over this last couple of years that it made sense to be short put premium. But when you get into this condition, short put premium has much higher risk. And that's the importance of looking at that indicator. Here's the 2-hour chart. Now on the bottom over here, this is an important one to look at because this is the market condition indicator. This is a multiple time frame indicator that's weighted more for the longer time frames. And when it gets down to the 25, it says it's testing essentially. And when it crosses under the minus 25, it says that the longer term upside power is gone. Well, right now we're in the middle of that. So it's, you see it has a 4 reading if you look on the right. If it gets under minus 25, it will be giving us a negative reading. In the meantime, intraday momentum is negative, and if you were a intraday swing trader using the 2-hour chart for your directional decisions, this would be showing you negative. So as you can see, the overall picture in here has turned much more negative than we've seen in quite a while. And it says to me that rallies like we're having today should be held in suspicion. Now we'll look at the NASDAQ. You can see in here that the NASDAQ has not rolled over yet right there on the momentum. So that says, okay, let's give it a little bit more respect. Let's wait to see what happens. But if you look over at the daily chart right over here, this rallied and then took out this low here. So that says to me, when I go back to the weekly chart, the probabilities are pretty good that the momentum is going to turn down. And this decline right over here is going to take you out into this February period on the minor cycle, which would then take you down to, since it already got to this level right there at around 20,700, the next target would be down over here at 20,370. That's that next level, and that's a reasonable target for the downside over here. Right over here is 20,000, that 20,300 and change area. And again, the lower track put in there. We have this older cycle still in there. You know, like I said, when I was looking at the S&P 500, there's always the possibility that an older cycle ends up to be still in effect. If that were the case, then the market would come down, and here it would rally again and begin to take out these resistance levels. So we'll learn about that DJV as we move forward. As you asked that question about that, I think the highest probability is the shifted cycle right now, and we have that projected over here, especially when you look at a lot of the stocks that are projecting out into that late January, February timeframe for their downside move. So again, rallying up here, momentum has turned neutral on the daily chart, as you can see right here. Not turning negative yet, but it is very close to turning negative. and then you will then have a higher probability of following this downward track. The momentum in here again is neutral, and right over here the option bias indicator has turned neutral. It has not turned negative yet, so it just might be telling us that, you know, if you were a pair trader, it might be that the NASDAQ is the long side of it. You have to watch the intraday trading to really tell that. But NASDAQ a little bit stronger than the S&P 500, but not much when you look at the intraday. Again, the test here on the market condition indicator, and it's trading at 6. It needs to get under minus 25 to give you that negative signal there on the NASDAQ. So that's a look at the NASDAQ, a little bit stronger than we see in the S&P 500. And the Russells, the next one we'll look at on the weekly. So you can see these cycle timing lines right over here. And here is the range of the next weekly cycle. Now, you can see that this clearly has a momentum downturn there because it had turned more negative. It's actually a little bit stronger right now, these than the S&P 500 or the NASDAQ, but that's only on the intraday. It's just a little bit stronger, but still a very negative look when you look at this. And again, this comes out to March. Before this low is, we have it projected down here to 2145. But I wouldn't be surprised to see a test of this low here at 2060. Let me just bring that in right over here so you could see that cycle bottom right over there at around 2060. So that would be coming potentially down to that level there during that time frame. When I look here at the daily chart, again, you can see this bounce in here is a little bit stronger than we're seeing in the S&P 500. And while the S&P 500 and the NASDAQ took out this low, the Russell did not. So it's a little bit stronger. I had a note in here that when that previous cycle was forming, that the negative configuration suggests the next cycle will also be negative. So this negative configuration right over here says this one will likely be negative. This projection right there is to that upper level of the two I just gave you, which is at around 2140 or so, 2144 on the way down here. This low right over here projects out to late January. And this is that old one right over here on the Russell, which projects out to mid-February. So I'm not exactly sure which one of those will be in play, but you can see this does not look very good looking at that. Momentum negative right over here on the Slim Ribbon PO, negative right there. Here on the daily chart, negative. You could see the option bias indicator telling you keep your option positions on the short side. And here you could see it crossed here on the 25, gave you a test. It crossed to minus 25 and turned negative. That means the longer term support that had held the market up is now gone and is, if anything, exhibiting negative pressure. That means the longer holders are in a sell mode when you look at this, and that's going to help it get to that downside targets that we're looking at right over here at 2144, so 2060 right over there as we look at the Russell. So that's a look at those three indexes in a very, very deep look as we look at just the indexes. But I want to show you our indicator bias heat map, which I think is just a fantastic way to look at the market with our indicators. Before I look at the heat map, though, I want to jump into a real quick look at the final. This is our final weekend now, and the time running out. Forgive the gift. So Matt is going to give you a very detailed look at this at the end of the show. And so don't go away if you're interested in seeing a lot about our memberships and an opportunity to get this non-recurring membership just through this weekend. Again, you can go sign up in the holiday specials in the top, and you're going to get gift cards back from us at the lowest prices we ever offer these. You get $20 back for level 2, level 3, you get $50 back in an Amazon gift card, and level 4, you get $100 back in an Amazon gift card. And again, the lowest prices for everything that we bring to you here for level 4. And the reason I wanted to really talk about this is because I want to bring in this additional content that I want to show you. So let's take a look here as we bring in the market monitor here, the the indicator bias monitor. What we're looking at here are country ETFs, because I wanted to give you a good example of what the markets look like around the world. And you can see your EWZ, India, China, emerging markets, Turkey, all of them right over here. And our indexes down in the bottom: SPY, QQQ, Diamond, IWM. And this is the MCI, the market condition indicator, the option bias indicator, and the askSlim ribbon, and then the reversal scout. I have them in this order because this is the order of sensitivity. And you can see they're all in terrible shape. Turkey's the only one with some longer term still positive condition in there. But you can look in here, the MCI, look at these numbers. I mean, they're really negative. So you're coming into this beginning of the year with some very, very negative conditions in the market. It's going to be very, very hard to overcome what you're looking at right over here. If the market does get a rebound, you'll see the reversal scout turning green first, and likely that happening while these other things are turning red. If that happens and you can't begin to turn these other things green, these other indicators, then you're going to know you're in a temporary upside move, and you'll start to see them turn red again, and those markets begin to fall pretty sharply. I'm going to move in one more for you to see here, because I think this is so important, using our option, our indicator bias heat map. And this is, you're looking at about 110 stocks and ETFs here, as you look um, at the what are we looking at? Spider Select, sorry. And you can see in here we have, where's that? There we go. So we have XLE, XLF, XLV, XLI, and XLB, and all of the top 10 heavyweights in all of those. And you can see in here the ones that are actually getting a little money coming into them right now. Of course, energy is strong right now because oil is moving up. So you could see how the reversal scout is the most sensitive and beginning to turn in here. And the OBI is beginning to go neutral in some of these. So there's some better performance here when you look at um, the energy stock. So I can scroll down here, and you would expect that some of the things that have been beaten up last year, or some of the value things in the value area, might be looking okay. You still have Broadcom in here looking okay, that pattern looking pretty good, Cisco looking good. So you can get an idea of the ones looking at this that are the best. Here on the bottom, you can see money moving into utilities and the flight to safety. That's why these are green right there. And this really gives you an amazing picture of really the top weighted stocks in each of those categories. I'm just going to switch this over to the canned look at futures. So this is these are all of my watch lists that I look at in there, and the ones that say public are the ones that are in Thinkorswim. So again, become a level 4 member, and you'll get all of our charts and information on there. So I'm just going to go into futures right over here, and you'll be able to see this load up. It's amazing how fast and how good this is, as it shows you which of the futures are in the best and worst shape. Here's the indexes up over here, as you can see, all red. There is Bitcoin right over there. So Bitcoin actually has been positive, as you can see, but now in the shorter term is starting to turn negative. We'll see if that can turn positive again, and you can follow all the futures in here. Here's the gold market right over here, and gold, you can see, is red all the way across. So that is giving you an indication that the metals have some problems. And I've been warning about that. Here's your silver market right over here, and you could see silver red all the way across. So this is a great way to see. Somebody asked me about palladium, and I don't have those charts, but you can look right over here at palladium is red all the way across. So great way to really get a good look. Here you could see the grain market and how the grains, this is corn. Corn has been showing up bullish for us for quite a while. And you can see here on the indicators how good they look. So I wanted to give you a good look at that roadmap so you could see that heat map, sorry, with all of our indicators on there. And again, that's a level 4 service for the Thinkorswim platform, and you'll be able to look at markets the way that I just did if you become a level 4 member. So just fantastic.